G'day, Internet. Max right here, and one of our favorite guests to have on the show here at Success Council, Dr. Jeff Ross. Jeff, thank you so much for being here.
I'm happy to be here, Max. Thanks for having me back.
Awesome. So, as usual, we try to time these interviews with you just after the FOMC meetings. So, why don't you catch us up? Tell us the skinny. What's going on?
Sure. So the recent meeting was basically yet another nothing burger, nothing surprising. The Fed didn't raise rates, which is what people had expected. The markets were very confident they weren't going to raise rates, and they did not. He kind of kept his usual hedging on, we're going to be data dependent. We're all watching to see what happens. The way the market took it, though, and this is a good thing, I think, is that they're probably done raising rates. And then I thought what was actually more important recently this week was the release of Janet Yellen's, it's called the QRA. So basically what they're going to do, what kind of treasury issuance they're going to do, and how they're going to release it. So lots of good pieces of good news came out this week, and that's why risk assets are scorching higher, and while bond yields are coming down, and why the dollar is coming down. Basically because the bond market has been very concerned about the amount of issuance, especially on the long-dated side of the treasury spectrum, and the ability for the market to absorb all of that new treasury issuance. So longer-dated stuff, so like 10 years, 20 years, 30-year kind of treasuries. Basically that there hasn't been enough of an appetite for that. That's why yields have been going significantly higher. And when yields go higher, that's just generally not good for risk assets. And over the long run, it's definitely not good for things like if you're long bonds, or if you're a corporation that has debt that you need to roll over. 3 years ago you might have gotten that debt. If say you're a kind of a junk rated company, you might have gotten that debt for about 5%, but now that very same debt is more in the 10% or higher range. And unless things really improve for you in the last 3 years, and it's hard to imagine that they have, you're going to have basically an impossible time rolling that debt over. Anyways, any relief in treasury yields, any lower trending downwards of the treasury yields is generally a good sign for those kind of companies and for risk assets in general. And that, I think, has a lot to do with why risk assets are taking off this week.
Gotcha. Yeah, I noticed the bond yields come down and mortgage rates came down. There was a lot of relief for real estate investors. Significantly, like I said, just in 2 days, it went from like 8 to 7.5, pretty big deal. Mm-hmm. And this concept that you're introducing here, the rolling over of the corporate debt, I think is a monster piece of the economy. And most of that debt, I think it's fair to say, is in that medium term, 5 to 10 year range. Probably more at 5 than 10, I would guess. And this is, I think Raoul Pal talks about this excessively. It's like his main thesis is it's this liquidity cycle. Basically, the Fed has all this data. They know all these things have to be rolled over, and they have to lower interest rates before that debt rolls over, or else the entire economy implodes. Do you think there's much to that thesis?
I think there's some to that thesis. My take on it is that this may sound sinister, but basically that Jerome Powell and the Fed actually want to see some of these companies go under. I think he wants to trigger a small wave of bankruptcy, and as well as in real estate. I think commercial real estate, obviously residential real estate, got pretty out of hand. It was I don't think anyone would disagree, it's been in a bubble for the last 5 to 10 years or so, again, even after what happened back with the early 2000s. And so I think he genuinely wants to cool all of that off, but he doesn't want to start a landslide. He doesn't want to cascade, doesn't want to see massive contagion. So, getting to your point of rolling over debt, as a lot of this debt comes due for these junk rated companies and kind of lower rated companies, in 2024, there's a large wall of that debt coming through. They're not going to be able to pay it off. And to your point, again, we say rolling debt. Most debt isn't meant to be paid by companies and especially by the government, right? They just roll it from year to year, and that pile gets bigger and bigger and bigger. That's all fine and great, except for when rates are rising, because suddenly these companies can't afford to roll it over, so that debt comes due. The banks are like, you know what? We've been looking at your books. We're looking at your business. I don't think you're going to be able to pay that debt down, and so we're not going to give you a new loan, and in fact, we want you to pay us back in full for what you owe us. And that's when companies start to go bankrupt. So things, start hitting the proverbial fan. And so I think Powell wants to see that happen to kind of clear out, have some creative destruction a little bit in our system, but he can't let it go too far, because if it starts going too far, then you start talking about systemic contagion risks, and that's where the Fed would be forced to step in. So we'll see. I think everything is looking, to me at least, like it's slated to come to a head in 2024. I think we're going to see some real fireworks in 2024.
Okay, so about those fireworks, actually, we'll kind of work our way there towards that 2024 vision. I mean, it's only a couple months away here, but you had an interesting post on Twitter, which I highly recommend everybody follow Jeff on Twitter. It's at Valshire, am I correct?
At Valshire Cap, yes.
At Valshire Cap. I highly recommend you follow Jeff there. You had an interesting thing that you laid out your prediction of kind of, what you kind of see for, the rest of 2024. Why don't you go ahead and lay that out for us in terms of Bitcoin, but in terms of the broader stuff as well?
Sure. So two separate issues here, but basically what I see, first of all, like in the near future, what just happened recently this week with the things that we talked about, the surprise to the upside for the bond market, which basically caused this purchasing, this large, everybody's starting to buy bonds. Yields are coming down dramatically, especially on the long end. Even on the short end, they're coming down a little bit. And the dollar has broken. That portends well, I think. In fact, I tweeted earlier this morning something like Fed pause rally meet Santa Claus rally or something like that, because this is the time frame now where the traditional Santa Claus rally can happen, where basically stocks get boosted and do well into the end of the year. But then also historically, and I know we've talked about this on your show previously, I've been waiting for the Fed pause rally to happen for about a year now. But I think the market finally believes that we're there, that the Fed isn't going to be hiking anymore. We'll see. But as of now, the market believes that. So when you have those two things, those are big rate of change consequences. So when we go from where the rates are rising, and then they stop, that rate of change is super important, and it signals that we're kind of back in a risk-on environment. How long does it last? Historically, it lasts until it doesn't last. At some point, something will break. And what I look for a sign that things are going to get bad in the near term is that if we continue to see rates fall and stocks go up, that's often what happens into a major bear market correction, a recessionary type bear market for stocks. So if we see that, like say the rates continue to fall, say the S&P 500 and NASDAQ approach new highs, or even go past new highs, which is possible, I think, in the next 3 months or so, that would be a sign to me that we're basically on the precipice, and that it's going to be kind of a lookout below type moment. So that's equities. If that happens, I think Bitcoin would also catch a run. What would be a perfect storm in my mind from an optimistic standpoint is if the SEC approved spot Bitcoin ETF in the next month or so, which I think is possible. So, and some clarification here: if they approve it, there's actually a 75-day window. I learned this from my friend Stephen McClurg, who's the founder and CEO at Valkyrie. There's a 75-day window from when it gets approved until it actually starts trading. So about 2.5 months gap there. What I think would happen, based on how the timing of everything is looking, is that we would have a massive rip higher. I think that would be just super bullish for Bitcoin in the near term. And I think it could go, who knows how high, 50K, could go to a new all-time high. Adam Back is saying 100K before halving. That's all possible if they approve, and if we're in this sort of risk-on period. But all of that, I think, would portend to that's going to be a pretty significant crash coming later, maybe first quarter, second quarter of 2024. I think we would have a serious pullback. And so why would that happen? Basically, the Fed does not want to stop their tightening. They love to reduce their balance sheet. They love to kind of brag about that, how far they've gotten it down, about 1 trillion so far from its peak. They would be forced to intervene basically if there were no buyers of their bonds. So say we get to the first quarter or second quarter of 2024, and Janet Yellen starts issuing tons of new treasuries at the long end of the bond. Say she's given up doing it on the short end like she is now. Right now, the short end of the treasury, so the T-bills, 1 year or less, they're being absorbed mostly by the overnight reverse repo market. That has gone down from about 2.5 trillion at the beginning of 2023 to about 1.1 trillion now. So about 1.4 trillion has been taken out of the overnight reverse repo market to absorb the T-bill issuance. That means she has about 1.1 trillion left. So if she releases issues a ton of new T-bills, that will probably get absorbed. We'll see the overnight reverse repo market go down and actually approach zero. At that point, there's no more little hidden pools of liquidity for the Treasury to absorb their Treasuries. So when they put their additional Treasuries out, which are going to be more on the long end of the Treasury yield spectrum, that will have to get absorbed by the private market. If the private markets either run out of capital or they just don't want that those Treasuries, then who's the buyer of last resort? It's the Federal Reserve. So if that all were to happen, it happens kind of subtly behind the scenes, but what we would know what's going to happen because we would see the markets bracing for a recession. People would be piling into safe haven assets, risk assets, and I do think Bitcoin probably would pull back really majorly seriously, and who knows what that means. It depends how high they would get before then, but 30, 40, 50% wouldn't be unreasonable. And then I believe that would force the Fed to pivot, get dovish again, start quantitative easing again, be the buyer of last resort of these treasuries, and then that would be the basis for the next bull market and risk assets in the next bull market for Bitcoin.
Yeah, I mean they can't. I like this thesis. I think you champion it. I think I champion it. I think dollar milkshake theory. He champions it. Why is his name forgetting me? Brent Johnson.
Brent Johnson, yeah.
Brent Johnson. Championing the concept that the Fed can't come in with the bazookas. Like we all think it's guaranteed, and we're all right. It is guaranteed, but they can't come in on a whim. Like they have to come in to save the day. Yes. There has to be something that we need rescuing from for them to do that. And in terms of broad markets, in terms of equities, things like that, I think it's a very easy decision. There's maybe an argument to say that maybe Bitcoin could be somewhat immune from that. I can see the argument for it. But in the broad market, it just seems to be blindingly obvious that crash has to come. But like they've told us over and over again, they are going to tighten until it comes. But then the arguments come down to, as Bitcoin investors, is Bitcoin immune to that? And I think it happens so quickly, so fast, so shockingly. We saw it in 2020. We've seen it in other instances. It causes that cascade, and you get that brief window to buy at really steep discounts. It won't last particularly long, I don't think, but we will get that brief window to scoop up our last chance to get Bitcoin at really low prices before the next mega run. Is that kind of your theory as well?
It is, although I wouldn't, I always caution people, don't bet on that, right? And so I tell people, don't wait for this massive pull. I see some people sitting there they're still saying it's going to go down to 10 or 11,000. I'm like, you might be right, but you're probably wrong at this point. And if you're still sitting around in cash waiting for Bitcoin to dump down to 10K, you're probably going to be waiting forever as far as I'm concerned. So I tell people, you know what, just dollar cost average into it. In the meantime, maybe save a little extra supply of cash for if this event that we're talking about actually does happen. It may not happen though, again, to my point, if we get that perfect storm of optimistic things, we might see Bitcoin back up to 50, 60, 70, 100K in the near term, in the next 3 or 4 months or so. And then the crash would happen. And then maybe it comes all the way down to something like 30K or something, or who knows, 25K, something crazy like that. And yeah, that would be a great dip buying opportunity. But be careful. You're going to be really jealous and upset if you're sitting there on the sidelines and Bitcoin makes a run to 50 or 100K in the coming months.
That is a really, really good point. I have that challenge in here because I have this a big hodl account of Bitcoin that I never ever touch, and so I'm just with a relatively small portion of my investment portfolio. It's like, do I want to deploy this and try and catch a bull run over here? And that's how I think. But I realize that my viewers, so many of them are not in Bitcoin yet or thinking about getting into it or only in a very small position. And I was like, they do not have the luxury that I have to maybe, try and sit back and catch a bounce. You need to be dollar cost averaging into this. You need to be getting into it because these things may happen. They may play out. But if you don't have Bitcoin right now, oh my gosh, that's crazy. That is absolutely unforgivable right now. I just can't imagine that that's an acceptable strategy. If you don't have any, you must go and get some right now at whatever price, and at least start building towards some kind of a position there. Jeff, any other thoughts that you want to talk about? Interesting going on in the markets, macro style right now.
I think we hit most of it. There are major things going on. So, even though there's lots to be bearish about, I would say in the near term, things were just too bearish. They were oversold on lots of ways. We're seeing this massive rebound in small cap stocks right now. And I think, again, net liquidity, which we talk about on here, U.S. net liquidity has been chopping sideways since all the way back in April 2022. So we're going over 18 months now where that has been chopping sideways. U.S., especially small cap stocks, the smaller, the more attuned they are to basically just the U.S. only and not worldwide positions. They're very attuned to what U.S. net liquidity is doing. And so as net liquidity chops sideways, if you see, I tell people that crab markets tend to pinch both bears and bulls. And so if you see things get either too bullish or too bearish during a crab market, those are actually usually pretty good trading opportunities. So case in point, small cap stocks recently got wildly oversold, even though net liquidity continues to run sideways. That's generally a good buying opportunity. I expect small cap stocks to outperform going into the end of the year and do really well just because they got so oversold. So again, we're not at the recessionary bear market yet. You can sit on the sidelines if you want, but I think you're probably going to be having some FOMO if you're waiting too long and if you're too cautious at the moment.
Gotcha. Now let's play around with that idea that we kind of brought up earlier, that the Fed's only going to start printing in response to something. There's going to be some down pressure. I'll speak for myself, not for you. Confident that it's going to show up in equities and broader markets. Let's have a conversation. Is Bitcoin going to be immune from that? You've suggested not. You think Bitcoin's going to be, it's going to get hit as well. That is, it's going to behave like a risk-on asset right now. Let me, just for the fun of debate, I'll take the other side of that argument there. We've had a prolonged bear market now through Bitcoin. There's certainly a lot of Bitcoin has moved from weak hands to strong hands. I think a higher portion of Bitcoin than ever before in history is in HODL accounts that haven't, where the Bitcoin hasn't moved for over 6 months. The people who are here right now, certainly by and large, are true believers and are here for the long haul. That's kind of my argument for playing as best I can for why Bitcoin's not going to be hit. Do you think that argument has many legs?
So the reason why I don't is because, and I agree with you with everything you said, right? There are a ton of hodlers who are becoming OG Bitcoiners who basically have their Bitcoin, they own it, it's off of exchanges, it's in cold storage, they have it kind of safe and secure. The trick, the up and the downside of that is that means the actual tradable liquidity, or the Bitcoin that's on the margin, is very small. So that very small pool of tradable Bitcoin means that it's highly volatile. So if a wave of buyers comes in, that means it can be very highly volatile to the upside. But if a wave of sellers comes in, so say we do have this sort of recessionary bear market panic, what happens is people get margin called, and they right now, this second, need to come up with cash. And so if they have a little bit of Bitcoin, even though it's the best asset, everybody knows that, even though they may think of it as a safe haven asset, maybe they think of it kind of like gold or something. If it's available, Bitcoin is highly liquid, right? It's accessible 24/7, 365. That's one of the features of Bitcoin. But when you get margin called, that you may not have the option. You can't sell your real estate in like an hour. So you have to sell your Bitcoin. So that's why we can have these spikes down. So I agree with you. Even though it may trend higher in general through a recession, I think we'll see these spikes lower basically because of these margin calls and these low levels of liquidity. I would see that probably exactly how you do, Max. I would see that as a great buying opportunity, though, a chance to pick up some Bitcoin on the cheap. That would be a great time if you see fear coming into the market and you see this recessionary bear market happening. Put in some stink bid orders, right? I mean, say Bitcoin at the time is say at $50,000. Put in a stink bid order for 25K at the time, and you may actually get filled if that were to happen. So that's the way I suggest it. Have fun with it, right? You know it's coming. You have your stack. You're not really worried about what happens. But if you want to have fun and keep a little bit of cash on the side, have some fun, put some stink bid, or you never know what happens. Maybe you'll get a fill at 20K or something, or 30K, who knows? And that can happen. You can see even more volatility with the Bitcoin proxies that have higher beta. So consider, maybe putting stink bid orders on something like MicroStrategy or on any Bitcoin miner. They tend to be pretty good for those kind of short-term trades.
I love it. All right, Jeff, absolute pleasure as always. Thank you so much for joining us. After the next FOMC meeting, we hope to see you again. Guys, hit the like button, hit the subscribe button. If you have any questions for me or Jeff, go ahead and write that down in the comments below and let me know, what do you think? Is Bitcoin going to be immune from this crash? Is there going to be a crash at all? Is Bitcoin immune? Let me know in the comments below. Thanks so much, Jeff. We'll see you soon.
Thanks, Max.